Okay guys, now we earlier on I described the issue of tax efficiency, that it's very important not to have wealth in a personal name. So you might throw a question at me and say, Shillyboy, for someone like me, how do I then move these properties out of my name? What are the typical costs and what should I be careful of? That's a good question. I must comment for that. Right now, one of the things that will typically happen is that we're always careful of is, you will typically when you do asset transfer, you will typically be exposed to capital gain tax and transfer duty. That's from tax point of view, right? Now, how do we then make sure that those things are preserved? Firstly, let me explain what is capital gain tax. A capital gain tax, we arrive at it by making sure that we take what we call proceed. In this case will be the market value of that particular property minus base cost, right? And then we got what we call capital gain, and we apply inclusionary rate. As a natural person, we will use 40% because an inclusionary rate to a person, a natural person, it's 40%. And then we'll add that to a taxable income that you have. Hence, we say a capital gain tax is not actually a standalone to an income tax. It's actually part of it, right? Hence, we say inclusionary, right? Inclusion, right? So now, let me go back. I mentioned that we take a proceed, which I already defined it. I said it's a market value. Some of you guys might use an estate agent actually to get that. Some of you might use a Lightstone to actually use a Lightstone actually to actually get the market value. I've seen some people using the valuation by municipalities. Now we pretty much know how to get the proceed. So now, what is the base cost? Which is a very interesting thing. Why I'm saying this is because I've scenarios where most of you guys don't even keep records, that we find it very difficult now to quantify what is actually a base cost. So for whoever is out there, please keep records. What records should I be keeping, Shillyboy? Okay, now here's the thing. You buy a property. That's an acquisition price. That's number one. You buy it for $1 million. That's a cost acquisition. It's part of a base cost. You pay bond registration cost. You pay transferring attorney. You add that to the original cost. It's part of a base cost. Now, you'll find that there's a commission that you pay to estate agent. That's what you call base cost. You need to add that. You'll come to me and say, Shillyboy, I need to move these properties and then I charge you a professional fee. That also can be added to a base cost. Don't forget that. Don't forget to remind Shillyboy when you do that. Say, listen, Shillyboy, you didn't include your fees here. They need to be included. That's a base cost. You'll sound very smart, which is true. You need also to include valuation cost, where we need to determine, let's say you pay an estate agent to actually come up with the valuation of the property so that we determine what is the market value. You can add that to a base cost. So that's what we're going to get what we call a total balance, and we call it a base cost. Then we take that and then we minus against a proceed. Then we get what we call capital gain. So that's capital gain. But the whole amount is not being taxed. Lucky, which is something that is a debate for another, it's a story for another day, because there's a talks of wealth tax, introduction of wealth tax. We might find that in the later years, maybe South decide that actually the whole capital gain tax needs to be taxed. We don't know. But at the current tax legislation frameworks is that the 40% of that capital gain gets added to your total taxable income. Taxable income might be made up of other incomes minus other deductions. Other income might be your remuneration for salaries that you are earning out there, other things, that other incomes that you have earned out there minus other deduction. So you add that using certain sections. It get brought into your taxable income using certain section in the income tax. I don't have to go into the technicality of that. So then once it's added that minus other subsequent deductions minus other rebates that you as a natural person get allowed for, right? And then you basically get applicable tax rate. Then the final obviously will be the tax and all those other things that you need to pay to SARS. But obviously in that before you actually even apply that 40%, there's a 40,000 annual capital gain exclusion that a natural person deserve or they are entitled to. So you take a capital gain minus that annual exclusion, and then you get the net capital gain that you can obviously apply that inclusionary rate. My calculation is a simple one. I'm assuming that you have never sold assets in the previous years. Why I'm saying that also, it brings me to a situation where we've got a client, we had a case where this client of ours, he had these properties. They were not doing well, some of them. I mean, there were some that were not growing in terms of a capital appreciation. Some of them were actually not cash flow positive, which is very important. You know that as a property investor that you need to be investing in properties that are actually cash flow positive and also are growing in terms of capital appreciation, which is good. But this client had multiple properties. Some of them were growing and were cash flow positive, and others were actually not. So we needed to restructure that, right, to make sure that we streamline his portfolio. And it's what you call restructure, and we can help you with that. So now, what then we did, we said, it's not about just disposing your properties, it's not about just moving these properties away from your name. The timing is also important, right? The timing on when do you move these properties is important, and which properties do you move first, so that you are able to streamline, right? You are able to tax plan the capital gain tax, because you may find that you need to actually move this property this year and then move the other one next year, and you're able to take advantage of certain rebates that might be applicable in that particular year of assessment for you as an individual. So that's pretty much what you call an asset transfer. So we need to bear in mind on the issues of a transfer duty. We know that a transfer duty is an applicable a tax that you need to pay as a purchaser. So in your case, it might be the company, it might be the it might be the trust. So we need to be careful of that and that. I've seen a situation where it's a bit complex. We're using section 42 and we move things around, and you find that some of you guys, you find that you've got properties in your company. It gets complex because you may find that you actually have properties in the company, but then you own shares in that particular company, and that's still a problem, because a share, from tax point of view, it's a property. Should you die, it will be part of that. You'll be treated as the same as having owned those properties and indirect, because it's what you call a property. It will be subject to an estate duty. And then we already know we don't want wealth in our personal, meaning that you shouldn't even be owning shares in your personal name. Why I'm saying that? Because this is one of those things that most of you guys are not aware, that a company that owns residential properties, provided it doesn't meet certain exemption, and I don't have to go into those details because it's quite technical. It's what we call residential property company as defined, meaning that any movement of shares of that particular company will be subject to transfer duty. That's one of the things that you might caught off guard, that you're not aware of as a property investor. So you need to come to us, and we need to tax plan it to say, but then how do we then make sure that this thing doesn't? We do that, we do subscription of shares, we move things around, and we're able to make sure that we minimize as much as possible. But just bear in mind that at some point you're gonna have to pay. The morality or the fundamental thing here is to pay as little as possible, but not to not pay anything else. So with that said, that's pretty much what we consider in asset transfer. I think my part in short is that, please guys, keep the records, because it makes our job much easier, and we're able to actually also minimize those costs for you, the tax and the transfer duties for you, and in that way we're able to make sure that we pay as little as possible. Thank you so much for joining me. My name is Shillyboy. I'm head of tax at Intergen. Thank you.